Welcome to this week's Q&A. This week we've got a pretty good question from one of our viewers in Singapore, Simon, and he's asked, do you think equity markets are going to recover across the board or on an uneven basis? Now, it's a great question, and there's a lot more to it than simply the one statement, but the interesting thing is that history has already answered quite a lot for us, and that makes it a lot easier to actually give an opinion. So if we have a look at the major stock indices around the world, most of those have actually recovered from their pre-coronavirus induced highs this time last year, and it's been certainly an uneven basis on which that has occurred. But if you were an investor investing in passive investments, i.e. index funds, it would have masked what was actually happening in the marketplace. So, if we look at the major indices like the Dow Jones in the US, that had a pre-coronavirus hit high of about 29,000. It's now close to 33. If we look at the S&P, similarly, that's up on its pre-coronavirus trough highs. If we look at the NASDAQ, that's an interesting one. It's almost 35% higher than it was at that time. And that's been driven, as we generally know, by a lot of the large high PE tech names. So these companies have driven not just the NASDAQ, to some extent also the S&P, but mainly the tech-heavy NASDAQ as it's known. And that has generated some pretty outsized returns for a lot of investors. So if we look on it then on an Aussie-centric basis, the Australian All Ordinaries Index has lagged behind because it's still off its pre-coronavirus hit highs. And we can look at some of the reasons behind that as we go through this question. But it's important to note, say, if we look at Europe as another segment of the globe, the Euro Stoxx Index is about even. The FTSE in the UK is actually down. But again, we've got to look at some of the things that have played out there, like Brexit, which has had a major impact, I think, on businesses in the UK, as we all know. So, not to be unexpected. So when you look at this and say, do you expect markets to recover across the board? Well, most of them have. Is it going to be uneven going forward? Yes, I certainly think so. If you look at rotation that's been going on recently, that's something we look at too, where people are rotating out of some of these high growth names into more value stocks or cyclicals, so businesses that will potentially benefit from a reopening of economies as populations become vaccinated and potentially develop some herd immunity. So these things are now going pretty well at the cost perhaps of some of the names from last year. The tech names, if you look at companies like Zoom, where everyone started using that during the pandemic lockdowns, lots of other businesses like that which had fantastic results last year are potentially coming off those highs, and other companies are taking over. So there's a rotation within these markets that's occurring at the moment. The other thing that's very important, and we saw this a few weeks ago when we had international bond markets sell off really sharply, and as bond yields rise, of course, people will look at the relative risk, I suppose, involved in investing in equities versus bonds, and as yields rise, they become more attractive to investors as opposed to investing into equities, depending on the differential in the yield that they're likely to receive. I think at this stage and going forward, I think central banks are showing markets that they're fairly, I guess, focused on creating further employment in populations around the world. So they're looking to continue with their quantitative easing programs, keeping cash rates low, keeping interest rates low, and so I don't actually believe that the rise in bond yields is going to be sustained in the long term. Certainly there's room for them to move higher. I don't think that's going to cause a panic, but it may certainly cause potentially even a sharp sell-off in equity markets. So all of these things are possible, and we've got to be, I guess, as investors, attuned to that and thinking about these things, and be comfortable with the level of risk that we're taking with our various investments, to make sure that fits our tolerance, our risk profile tolerance, if you like. So they're important things, but then let's have a look at some other parts of history that we can look at right now. For example, the Japanese market. So the Nikkei index in Japan was about 24,000 prior. COVID coming along is about 30,000 now. Has performed very well. But more importantly, if we look at the rest of that equation, I mean, Japan has had rates at zero or negative rates for the last decade. And even if we go back the last 40 years, inflation in Japan has never been an issue. In fact, it's only really come out of the blocks above 1 or 2% twice in that time, and that was only for a period of a year or so. So I think to be fixated on the situation where we see central banks providing negative cash rates, QE, all of the other things that many people call money printing, it doesn't necessarily mean that we're going to have runaway inflation. And I think that's the important issue to bear in mind. And I recall the last economic shock that I remember very well, which is the GFC, and at that time I thought similarly. There's only one way we're going to be able to repay these debts that we're creating from a sovereign viewpoint, a public viewpoint, and that is basically that inflation is going to have to come along and inflate away a lot of these debts. In other words, the debts would become worth far less money in real terms at that time. And that didn't actually eventuate. So I think, you've got to consider that the jury's out on all of these things. I'm not sure that inflation is going to be a major issue. In fact, most central banks are quite pragmatic about the fact that they are willing to let inflation run higher than their target bands to make sure that we do get some significant wages growth and full employment in our economies, which is going to stimulate those economies, in turn potentially increasing inflation. So I think from a broad spectrum viewpoint, it's really important to make sure that you look at all of your investments as a whole, look at your asset allocation, see how that dovetails in with many other things that you're doing, and we look at it on a more holistic basis because, generally speaking, the growth assets that people can invest in are shares and property. So if you look at those two growth asset classes, both are performing well at the moment. I think both of them are uneven to many extents in various markets. So that's also really important to think about. People need to do their research or have someone do the research for them, because it's not simply just tossing money at something and thinking it will go up in a uniform manner. That may not happen. In fact, the likelihood of that happening is potentially, I think, lower than it has been at times in the previous cycle. So, I look again from experience. If we look at this time last year, early 2020, we had our clients' growth portfolios overweight in cash. At that time, the thinking was that a lot of equities had become reasonably expensive on most metrics. So it's important to now look at that again, and we've got to look at that in light, I suppose, of the major shift that's happened in interest rates, in long-term bond rates, in short-term bond rates, overnight cash rates, and make accommodation for that. But I think, again, one needs to actually be cognizant of pricing at the moment. And that being said, I still think that growth assets, shares and property are going to give investors a better yield than fixed income at this present time. So important to look at that. Make sure that you invest soundly in terms of having had your research done for you. So you're locating things that are going to potentially give you the levels of capital growth and income that you desire, or if you're happy with excess volatility, you may seek to invest in assets such as that, where perhaps there is no yield, but there may be large capital growth or capital declines as well. So you've got to actually judge what suits you best, in what percentage or what proportion, and then act accordingly. So Simon, I know it was a broad-based question, but if we look at that, you know, a lot of the recovery has already occurred, and I think really what happened was a lot of people were caught unawares by the speed in that recovery. So if we go back just under 12 months, I think it was the 23rd of March last year when we hit the sort of bottom of most equity markets around the world, the speed with which that recovery came through caught a lot of players unawares. And I remember speaking to people saying to me, look, I think this is just a dead cat bounce. Well, you know, the cat's well and truly out of the bag and certainly not dead yet. So I think people need to be cognizant of things happening, and I believe potentially the greatest, I guess, misfortune that investors can face is that of simply doing nothing, of procrastination, where they continually to wait to find a bottom, rather than saying, these things look like pretty good value and I'll buy that, even though I know potentially that may go down further. And that generally happens with most assets. You know, they have the ability to go up and down, otherwise we generally wouldn't buy them because we're looking for them to go up over the long term, and that's also what happens. So you'll get potentially a wave pattern that has a positive incline, and that's what we need to look at. So people sitting on the sidelines, and I get it now, you know, from clients, particularly in Sydney, is saying they were looking to buy investment properties, and they're saying now, oh look, I think I've missed the boat. What's interesting, you know, given the fact that even the Reserve Bank suggests that perhaps we can see up to a 30% real return in property assets over the next 3 years. Most economists agreeing that things are going to go up certainly for 2021, 2022 on a reasonably significant manner. So I don't think that's the case, and I think people just like to buy things at the bottom, and it's human nature, but it's not really a massively intelligent way to invest. So trying to pick bottoms and pick tops, well, you know, someone may be better at it than I am, but I find that's not really a very consistently positive outcome if you like utilising that as a way to invest. It's far better to look at trends, and at the moment, if you want to act conservatively, it's probably going with that trend as opposed to going against it. So I hope that's been of help to you, Simon, and to other people who have had similar thoughts cross their minds or similar questions. I know many people are thinking about this. We all do. Certainly in the business of managing money or managing assets, most money managers look at this and think about it on a daily basis because they have to. So a really great question. And as I say, history is the best teacher, so we'll have a look at this again perhaps later in the year and see what transpires further. All the very best, and I'll see you next week at our Q&A.